Okay, good afternoon, everybody, and welcome to the meeting of the Tax Review Commission. This is January 20th, and Happy New Year to all of you. Our first order of business after the call to order is communication to the Commission and public testimony. Do we have any written communication, or does anybody want to speak to us today?
There's no written communication.
Okay, well, not seeing anybody coming forward with oral communication, we will go on to the next. The minutes of the December 16th, 2020 meeting, are there any corrections or additions? Did everybody get a chance to read them?
Is that the communication that was emailed to the members on December 18th? Is that the last that we have?
I believe so.
If there's no changes, I would motion to approve.
Thank you. Can I have a second?
Second.
Thank you. I'll take you, Kate. All in favor?
Aye.
Indicate by saying aye. Any opposed? Thank you. Minutes are approved. Report council members' communications with stakeholders. I don't know whether any of the rest of you have been talking to anyone in the community. I myself, I met with Colbert Matsumoto on December 17th and had a general discussion about revenues. And I also met with Senator Dela Cruz and the staff of WHAM on January 7th. Okay, hearing no more. Let's go on to item number 5, the presentation on individual income tax by Seth. So take it away, Seth.
Okay. So can you see the whole entire presentation? Not a presenter mode, everybody can see pretty well?
Yes.
Okay, great. So today we're going to talk about the income tax system, right? So last week we talked about GET. This week we'll talk about income tax, which I'll incorporate individual income tax and corporate income tax. And then next session we can talk, or we will talk about TAT, and I like to include a little bit of property tax in there just because it is a really important tax base for many state and local governments, and it's important to understand. I think it contextualizes how Hawaii is quite unique, right? In that they're not allowed to levy a property tax at the state level. So it just puts some things in perspective. And so you guys can think about that as you deliberate and as a commission, after which I am happy to keep going and doing some individual, or looking at like the tax incidence, which means who pays Hawaii's taxes. And we can look at that, but I will defer to you guys going forward. So at least for this time and the next time we have a presentation, and then we can discuss if you guys would like any more background information. So I like to start off with this slide, which gives you a little bit of a traditional way that an economist would normally think about the economy, right? So the economy, one model to think about the economy is there's different types of inputs. Firms take those inputs and then they produce goods, right? And so there's two different inputs. There's labor and there's capital. And generally, economists don't like taxing inputs. They would prefer to tax outputs. And the reason is because if you have tax on inputs, especially if you have a differential in the tax rate between labor and capital, you're incentivizing the firm to choose one over the other, right? So if I taxed, in this case, if I taxed labor at 50% and I tax capital at 0, my incentive of a factory owner is to buy more machines and not as many labor inputs, right? And so generally there's this feeling that you don't want to tax inputs at all, and you want to leave that up to the private market to figure it out. And that's why, you know, in general, economists are much more proponents of consumption taxes like the GET, or, you know, around the world when are the VAT taxes, the value added taxes, right? And there's a couple reasons for that. One is it doesn't really influence inputs as much, right? You're only really taxing outputs. The other thing is when you are taxing individual income, you're taxing potential savings as well as consumption, right? Whereas if you do the consumption tax, you're only taxing consumption. And at least in the 1950s and 1960s, and we can discuss why this might be different today, generally it was good. People considered that a higher savings rate was desirable because that would increase the amount of capital available for investment, right? Things are a little different today with interest rates so low, and a lot of economists are arguing that there's a glut of savings, and so you don't need to do that as much. In general, these yeah, I'll talk about this in the next slide, but does anybody have any just questions about this basic model that I presented? Okay. So why, if economists generally like taxing outputs, why do they tax inputs at all, right? And why do governments tax income, labor income, more than capital income normally, right? So this is the case in Hawaii, this is also the case in the United States, you know, the capital gains, long-term capital gains rate is lower than the highest marginal tax rate. Why is that? One is capital is mobile, right? And labor is harder to move around, right? There's only, if you want to provide a service or a restaurant here, you have to have local workers, so they're easier to tax. Somebody from a capital ownership can move from it or come from anywhere else. Capital accumulation is strongly correlated with growth, right? So this is kind of like the traditional thinking that like you need lots of savings to make lots of investment and to help the economy become more productive, or more productive. Most governments do, for this reason, most governments do tax capital less than labor, right? And however, you know, this setup is a little bit more thinking about at the national level. The other thing that people need to think about at the state level is, you know, there is a national labor market, right? So people can move between different states, and the income tax rate, which is basically a tax on labor, is pulling out the capital gains rate, is a tax on labor, and people can make decisions, and firms do make decisions, right? So, you know, famously, you're seeing this a lot now, right? So a lot of tech employees and stuff are moving out of California, which is traditionally a high cost and high tax state, to lower tax states, right? And most of them are moving not to Hawaii, but to Texas, to other places with little to no individual income tax. And that makes it a big difference. And firms recognize this, right? And they actually lower your salary because they understand that it's less expensive to operate in different places. And so one of the things that we're going to see going forward is labor mobility, at least in upper class or like higher paid professions, is that going to increase as a result of this pandemic, right? If that does, then that does have implications for our tax policy, right? Because as we'll see, Hawaii has one of the highest tax rates, individual income tax rates in the country, right? And so, you know, one thing to think about is, you know, there has been a push in the media to attract these digital nomads, these people that are coming. However, you know, the second line that comes after that is so we could get their tax revenue, right? However, they're making a choice amongst 50 states, which includes the beauty of Hawaii, but it's just part of the package, right? And so this is something to think about, that while as labor becomes more and more mobile, there's going to be more and more competition to incentivize those people to come to your economy and spend money and be there over time. And how that plays out will be an interesting development within the United States, I think. So I just did this. When you review the literature, what is the optimal rate of taxation? And according to the economic literature, it's somewhere between the range of 0 and 100%. I'm sure you've heard this. The thing is, if you lined up all the economists in the world side by side, what you would lead up to is not 1% or not one agreement. So economists are notorious for disagreeing and having different views on everything. But the bottom line is the optimal marginal rate of taxation is unknown. However, they do influence people's decision making, right? And so as income taxes get higher, people are more likely to leave the workforce and leave the tax jurisdiction, right? And so this is the concept that, like, if you're making, especially, this is the idea that if you're making enough money to support your family and do everything you want, and you're just earning extra money for second vacation home or whatever it is, if you increase the tax rate too much, a lot of people will pull back the amount of work that they do because it's just not as valuable, right? So if you raise the taxes from 10% to 80%, my guess is you would have a huge decrease in the amount of the supply of labor offered to the workforce, especially amongst the higher income people, because they can already satisfy their basic needs, right? And also, when you raise the individual income tax, they can substitute it with capital, right? So this is, business owners paying themselves with equity and shares and different things. And so in which case they're taxed at a lower capital gains rate. And so if there's so many, there's downsides to the income tax. Why is it one of the favorites? And the biggest, usually it is favored because it helps with redistribution, right? So there's this whole concept in the public economics literature about taxes and ability to pay. And ability to pay is the idea that, and we were talking about this last time, is like, wealthier individuals tend to have higher levels of discretionary income, and so society generally believes that they have a higher ability to pay taxes, right? And so their tax burden is lower. That is definitely the case in the United States. That is definitely in the case of Hawaii, and that's what we do. So instead of having all these kind of a flat tax, right, where everybody pays the same thing, you have these graduated tax schedules, right? So this goes up. Generally, the rate goes up the more you earn, and so that's what they do. Two things to think about. One is income is not wealth, right? So there's a lot of talk about wealth inequality. However, that's really difficult to tax, right? The only thing that's wealth that's pretty straightforward to tax is land and property, but other types of wealth are harder to tax, right? Because the way our tax system is, like, there's a bunch of money or wealth in the system, and it's only when you take your money out is when we tend to tax you, other than property tax. And sometimes boats and airplanes are taxed as well. We have it's not explicit, but we have a tax on vehicle registration, which could be interpreted as a wealth tax because everybody owns cars, right? And they charge you. I pay $300 a year to register my car.
Excuse me, Seth.
Yeah.
Do we tax boats and airplanes?
I do not think so.
Thank you.
Or we don't have a specific tax. We have the GET, but we don't have a specific like boat tax or anything like that. And again, one of the problems with income is it's, in economics terms, we call it fungible, right? You can move it around. It's very easy to hide, or it's a lot easier to hide income than it is to hire, especially at the higher levels, than to like labor, right? So for example, I get paid on W-2. The government knows exactly how much I make. If I was a business owner with lots of different things moving around, I could create shell organizations and everything, which could be completely legal, and I could lower my tax rate, right? And I could move my taxes into different tax jurisdictions, right? And that's just the nature of where we are and how things are. And so one of the things when we always think about raise it, or we see proposals to raise individual income tax rates, is they're really hard to price, right? Because the behavioral response to higher individual income tax is very hard for us to figure out. It's never just, oh, this is the amount of money people are making at, 8%, and then they're going to have the same amount of taxable income at 9% or 15%. We just don't know that, right? Because people will move their taxable income around.
Seth, would the so-called federal death tax, inheritance tax, be considered a wealth tax?
Yeah, I would consider that a wealth tax. We can talk about the wealth tax. Is the estate tax is really interesting, I think, and there's a lot of from my reading of like the public press and everything, it's not there seems to be like simplistic arguments on both sides, right? They're either called a death tax, or they're like, oh, all these people are just passing generations of money on to the next one. And if you really look at the ins and outs, it's really complicated, right? And estate planning is an industry unto itself. So we can talk about that later if you guys are interested. But I would consider it a wealth tax, right? So I just built this little chart to help you guys think about income tax versus consumption tax, right? So we have the last presentation, we talked about taxes are often evaluated through different metrics. One is equity, efficiency, administrative burden, and avoidance. On the equity issue, in terms of being able to be more progressive, individual income tax is definitely there, right? And you see this in all generally rich countries have some form of individual income tax, and they all tend to be progressive, right? There's the efficiency, finding people, auditing people, figuring out what their income is harder with individual income tax, because income is, like I said, fungible, moves around. It's a lot easier with a consumption tax. The other thing with the individual income tax is if it gets too high, it discourages people from working, and it discourages people. It's a tax on savings, right? The administrative burden is easy to moderate for income. It's a little lower for consumption tax, and the avoidance is higher. It's easier to avoid individual income tax than it is consumption tax generally. So since we do talk a lot about ability to pay and equality and equity, I wanted to look at inequality in the United States and Hawaii, right? Because one of the things that's happening I think in this country is we're nationalizing every single debate, right? So the issue about inequality is a national discussion, right? However, Hawaii's economy is incredibly different than New York's, definitely different than Connecticut, where all the hedge fund managers live, in California, right? So we need to think about things before we implement them. So let's start off at the national level, right? And the national level is the United States tends to be the most unequal rich country in the world. You can see this, you go all the way down to Iceland, all the way up, and United States here, United Kingdom, Australia. These are like, incidentally, these are all kind of like Anglo-Saxon economies, right? Which are economists think of differently than the continental European economies, but like the UK, Australia, you know, Canada's higher up here. We definitely have higher levels of financialization and just different labor agreements, lower levels, yeah, different labor agreements than the rest of the rich countries. So even though we're one of the most unequal, we do have the most progressive tax system at the national level in the country. And what that means is if you look right here, the percentage of the top richest deciles, their tax burden is higher in the United States relative to other places. And so what we do is we tax, we have a higher progressive tax rate in the United States, and we do engage in more distribution through taxation, redistribution through taxation than in other countries. And however, that being said, here's the United States. Now, these are all charts that show the amount of redistribution that occurs through taxes and transfers, right? So you can either tax and say, we're going to tax the upper income person and give it to a lower income person, or you actually can just like give them government transfers to make sure people's incomes are more equal after the end. And what you'll see is, you know, what you kind of Denmark, Belgium, Sweden, I think Sweden, this is usually Switzerland, Austria, they engage in higher amounts of redistribution, right? And the United States down here has one of the lowest redistribution rates of all the OECD countries. Only like Korea and a couple of these other countries have lower redistribution rates, right? And so how does that work? So this is another chart that shows the Gini coefficient. Gini coefficient is one of the most common ways of looking at inequality in the United States, in a country, within a country. And so if you have a Gini coefficient of 1, that means one individual owns all the wealth in the United States. And if you have a Gini coefficient of 0, that means everybody has exactly the same income in the whole entire population. And it's logarithmic, so it doesn't really, most people are between, or most countries are between 0.6 and like 0.3, 0.2. However, this goes to show you, and this is the top of this graph is the Gini coefficient before taxes and transfers, and this dark red one line is the Gini coefficient after taxes and transfers, right? So there's two types of ways to do it. You can do it through transfers, which is the pink line, and the red line is through taxation, right? So we get down, and so if your goal is a more equal economy, which is also not debated pretty vigorously within amongst different people, but if you look at the United States, we're down here, right? And so we don't engage in we don't give a lot of transfers, right? Most of the inequality that we do is through taxation. And so even though we engage in less and less in this, we still have one of the higher rates of inequality amongst the OECD countries, right? And so that's the idea here. Does anybody have any questions about that? So the reason I bring this up, right, is because we usually in the United States, I do see, and also because of my position, one of the things that we are trying to address through inequality is using our tax system, right? However, the takeaway here is the other countries that engage in higher levels of redistribution do it through transfers. And this is through providing higher levels of social services, higher levels of making sure that, like, you know, in the United States, when we provide our social safety net, it is very targeted and generally only for the lowest income, the lowest of the lowest income branches, right? In Europe, they tend to be higher and they tend to have more universal transfer programs, right? So you can think of universal, like, healthcare. Everybody gets healthcare in Europe. In the United States, it's privatized unless you're in the very lowest income levels. So that's just something to think about. And when you're thinking about, yeah.
When we provide tax credits like the EITC or the low income renters tax credit, is that considered a transfer or a tax expenditure of some other?
That would probably be a tax. The transfers are more like if low income rental assistance or SNAP, those types of things are more transfers, right? Because if you think about the EITC, the taxation, it would occur through a taxation because essentially really low income people in the United States or in Hawaii do not have individual income tax liabilities, right? So that being said, let's look at Hawaii and how unequal Hawaii is, right? And Hawaii is generally one of the most equal states in the country. We usually compete with Utah, which is almost always the most equal state in the country for a bunch of interesting socio economic reasons. Hawaii is there. And one of the, probably the biggest reason is we don't have rich people, right? So inequality, the largest driver of inequality is the disproportionate that the gains of economic growth have gone disproportionately to the highest income levels in the United States. And this is not just in the United States, this is all around the world, right? And so, so you would expect the places to have the highest level of income inequality is, you know, New York, California, Florida, Massachusetts, the big cities, which are huge economic drivers that have, you know, they have their finance, they have their tech, they have their CEOs. In some cases, they even have sports stars, things like that, that can claim higher income tax. In Hawaii, we have none of that, right? So really the amount of truly wealthy people we have that are claimed as state residents, and that's the only people that really have, we can tax through the individual income tax effectively. We just don't have that many people. So that's something to think about when you're doing state inequality. This is just another way of looking at it. This is the top 1%. So the top 1% take about, this was up till 2012. It hasn't changed that much. I'll show you a couple of graphs in a second, but top 1% takes in about 12% of all income in Hawaii. That's compared to about 20% in the whole entire United States. And so what's kind of interesting, this is the red line with Hawaii. This is the United States. In Hawaii, you know, after what you would imagine, like when it was in the territory days, when the distribution was much less equal, right? And you had, it was much more of a plantation economy. It was incredibly unequal, more so than the United States. It came back during statehood levels and has increased like the rest of the United States, but much less than the rest of the United States. So just one of the ironies of Hawaii is we have a high level of median household income, right? So we're the 5th highest in the nation with $80,000 as your average household income. However, like it's really skewed towards the middle, right? So if you want to be in the top 10% of all filers in Hawaii, if you make over 140,000 as a single person or as a joint person, you're in the top 10%, right? So most of the people are pretty middle income spectrum. And so you can also see this is the top income threshold of filers by state, right? Connecticut, no surprise, is the highest, right? The reason why Connecticut always beats out New York is because all the hedge fund people live there and it's a smaller state, whereas New York is much bigger. And that includes upstate New York, which drives down these averages. But, you know, you can kind of see it's, you know, you got like essentially the tri-state area, Massachusetts and California, which is where our huge engines of economic growth are. And then Hawaii is very far down the chain. So, you know, to be in the top 1% of income thresholds, you need to be $414,000, right? And as a percentage of share of all income, we're lower, right? It's 14.1% versus higher up here. And this is updated data. That's why it's not, this is from 2012 and this is from 2017. That's why it's slightly different. So that's just a short divergence of on inequality. I share that with you mainly because like like we discussed before, one of the major reasons we do have an income tax is for redistributive purposes, right? So I wanted to have you guys think about that a little bit. Does anybody have any questions? So much easier on Zoom. Some people are so much less likely to talk. So just looking at how Hawaii Hawaii fares in terms of the individual income tax, you know, the national average of all state and local revenue is 23%. For Hawaii, it's 21%. So it's pretty close to the national average for the individual income tax rate. And I showed this to you last time, but I'll show it to you again, is, you know, the individual income tax, the relative weight of the individual income tax, which is here in red, is increasing over time, right? Because we're relying on it more and more. The legislature is relying on it more and more to raise revenue. It is also more economically volatile than the GET. So it goes down more during times of economic decline, and it increases more when you're in boom times. How this will play out during this current economic downturn is, so far we haven't, we don't know, right? Because there's two things that are happening this time around. There's one is the government is engaging in much higher levels of fiscal stimulus, and the Fed interventions have really intervened, and stock market and other forms of capital gains have really increased and are higher levels than they were before the pandemic. So we'll see what happens there. Notable things about Hawaii's individual income tax: we're very progressive relative to other states. We have a lot of brackets, more brackets than any other state in the country. Our brackets are not indexed to inflation, so that's a big deal. That's unlike the Federal Reserve. What that means is every year, the state is getting tax revenues are higher than would normally be anticipated if you're looking at strict economic growth, because everybody is being pushed into higher levels of the income brackets, right? Even though the ability to consume has not increased through inflation, the level of taxation in the state of Hawaii has increased. The other thing that we have that's notable is we have really low levels of standard exemptions. So people have to pay individual income tax sooner than compared to a lot of other jurisdictions. We have refundable credits and non-refundable credits that offset the burden for lower income individuals. And, you know, a lot of retired people do not have high income tax liabilities here, right? And so that's one of the, you know, the Lingo administration brought this up. It's kind of like one of the third rails of Hawaii, the Hawaii taxation system, but it's still legitimate and needs to be at least acknowledged. So this is kind of the breakdown of income for Hawaii. What you'll see is most of the things are wages and salaries. Capital gains is actually pretty small, right? And then there's pensions, Social Security. So it's about 16% is retirement income. Now IRA distributions are taxed. It's only defined pensions that are not taxed under our current system. And so we'll see, like, just kind of going down, we have different rates for all of these different things, right? So wages and salaries is taxed at the tax bracket. Pensions and IRA, it's 0 if it's employer contribution. If it's an IRA distribution, then it is taxed at wages and salary rates. Self-employment income, it's variable. That gets a little bit more complicated. Social Security tends to be exempt. Capital gains 7.25%, and then interest and dividends is taxed at as normal income. So Hawaii has one of the highest marginal income tax rates in the country. The only one state that has a higher one is California, and that kicks in at $1 million a year. And so Hawaii has some of the highest rates at the lowest levels. We have only 43 states levy individual income taxes, 8 of which have a single rate structure. So for example, I think it's like Colorado, it just says, you know, it's 4.5% of your taxable income, federal taxable income, and that's it, right? They don't even look at exemptions or anything. Yeah, and we have a lot of tax structures. And so you can kind of see these are the higher end ones. I forget what the average rate is, something around like 6 in the United States, like 5.5 or 6% for the effect. And these are marginal tax rate. These aren't like the effective tax rates, which are different. So I just kind of like picked a bunch of different taxes to kind of show you different tax brackets. And this is selected. This is for joint filers. So as you know, if you're a single filer versus a joint filer, joint filers generally have twice as high as rates, but I just picked it all to make it as easy for everybody. So like I said, Colorado has just, it's 4.63 of the federal income. They make it really easy for themselves. That's a flat tax. There's no distributional impact for that at all. Virginia kind of kicks in early and stays pretty flat, 5.75. Maryland has a much more graduated tax, right? So between 4.75 and 5, it's basically flat. California has the most progressive tax system. So what you'll see is like the rates are pretty low until you get to around 60,000, and then they get really high on the upper end income. Hawaii is different, right? Because we start taxing around 5.5% at 10,000, right? So like the taxes start off low and then they increase relatively quickly. Again, since we don't index this to inflation, it stays the same way. And then the other unique aspect is we have all these tax rates that don't really change. It's if you look at this, it's pretty uncommon to have rates that only change by, what is it, 0.4% in brackets, but we have those. So that's just kind of something unique. In reality, like, since we do everything by computer, it's not like it really matters for your taxes, right? TurboTax can handle 100,000 or 1,000 different tax brackets, but it's just something to think about.
Seth, I'm assuming that all of those states are marginal tax rates. These are.
Yes.
It's not common to have like the top rate apply to somebody's entire income.
That's right. And and that's a good point. So all of this is marginal. And one of the reasons we have graduated tax rates is you don't want somebody that, one of the ideas is if for the first $10,000 of income, no matter if it's, you want everybody's income to be taxed the same, right? If not, you have a bunch of like these kind of like tax cliffs that create a lot of problems with incentives, right? So if we can just look at here with, let's say 8.25 goes from, or let's go from 8.25 at $96,000, and then it starts going up at $300,000, right? The only dollar that would be taxed at the 9% rate is if you made more, every dollar after 300,000, right? And so the effective tax rate is always lower than this. And the reason is you don't want to create an incentive where if all of a sudden you earned $300,000, you would be earning actually less. If everything was taxed at the same rate, if you earn $299,000, you would earn, your take home would be more than the $300,000 if you earn $300,000, right? And we want to avoid all those kind of massive disincentives, right? And so that's why we have a gradual effective tax rate. Sometimes, you know, we'll get proposals from legislatures that are like, oh, lower income people shouldn't be paying taxes, so let's just get rid of all these lower tax rates. But then you end up having these huge tax cliffs, and it also applies to everybody, right? So nobody's paying taxes on this. So you really have to think about every level of income should be taxed the same, and that's a basic principle of tax theory. And so you really have to take that into consideration when designing tax brackets. So I just kind of did this as a fun little example, but you know, I looked at like one issue of progressivity is like looking at how much a higher income person pays to lower income people. So I did this for married jointly, filed jointly, for different income levels, and you look at the effective rates as well. And so I took the effective rate, and what I did is I took, what's the ratio of somebody earning 350,000 or a household earning 350,000 to 50,000, right? And so, and the marginal tax rates. So California is definitely the most, the highest rate, or the most progressive, but Hawaii is the second most progressive, right? And you kind of see Maryland, Colorado, Virginia, they're essentially almost flat in these ranges. So Hawaii does have a progressive tax rate. This kind of just shows you the number of taxpayers per tax bracket. And for this, again, this is for joint filers, but you really can see the distribution here pretty well, right? So we have about 20% of the people are below this. This does not mean that people are low income. My guess is most of these people are the retirees, right? So a lot of people have no taxable income in Hawaii, even though they do have taxable income at the federal level. And that's what usually occurs here. And then you don't really have anything. And then right here is where you get the bulk of the taxpayers, right? So, and that's between 48,000, 300,000. So most of our taxes are occurred here, most of the taxable income. And, you know, at the very high end, even though they don't represent a high level of taxpayers, that's the definition of being rich, right? Is you own more than other people, right? And so this is what they have. And what you really, I include this here is Hawaii is an upper middle income state. That's really expensive. So the take home income does not, the buying power of most people who live in Hawaii is substantially lower than it would be on the mainland, right? But in terms of like, who are the economic impact actors, essentially what you see is right here. It's a middle income state. And this is just another way to look at the distribution, you know. This is different Hawaii AGI classes and their tax liability. And so you see that like the really high income people have a higher level of tax liability, which makes sense. And then most of the other tax liability comes from these, you know, middle class people-ish people.
Seth, can you discuss a little bit what are the tax credits that people are getting, particularly the ones at the high end of the spectrum, but for everybody? I am more familiar with tax credits for people at the lower end.
Yeah, the biggest tax credit is the taxes paid in other states. So generally higher income people, like in all states, we generally, if you've paid taxes in another state, you're not required to pay taxes on that same level of income. So that's a big one. We've looked at this. The renewable energy tax credit is also up here. And that's also right here. For down here is like the refundable tax credits, right? So, or the targeted tax credits, so it's the EITC, the refundable food tax credit, the renter's credit, things like that. And this is just another way of looking at progressivity, right? So this is the amount of your tax liability over your share of taxable income. So if you had a 1 would mean that if you have 10% of your income, if your income represented 10% of all of Hawaii's income and you paid 10% of all of Hawaii's taxes, you would have a value of 1, right? If you paid, in this case, if you paid 126 or 26% of Hawaii's taxes, no, that's not 26%. It's if you, this is saying if, yeah, this is saying if you, I'm trying to think about this right now. If you had 26%, your taxable income, your tax liability is 26% higher than your taxable income as represented for the rest of the state, right? So what this means is, you know, people in the lower income distributions, their income, the amount of taxes that they pay as a portion of their income is lower, right? And up here it's higher. So this is the just kind of like a normal progressive tax structure that you would expect, right? Because what the definition that we shared last time is, it's not about the absolute amount, which in absolute terms, these people pay more in taxes, but it's relative to your total income, right? And so since people are paying more tax relative to total income, this is the definition of progressivity. It's higher for these people and lower for these people. This is another way of looking at it. This is the average effective tax rates for residents before credits and after credits. So you see what, like, it's relatively flat here and then increases up here and goes down at the lower income and distributions. You can always see the big impact that credits have on reducing the burden of low income individuals. And again, up here, we always get this question, and it's mainly because of taxes paid in other states. When we do individual income tax, it's basically residents who pay, right? So we get really mad at, or one thing I see is people get really mad at the inequality that exists within the United States, and we should tax these people. However, if you go back to what I've been saying, we don't have high levels of inequality, as high levels of inequality as in the rest of the United States. And when we try to raise the individual income tax here, and when we do, we're just raising it on residents. Residents pay 92% of all individual income taxes. So if you're trying to get like the tourists, the people who own a second home here, we don't collect a lot of that through individual income tax. And most of this is probably from people who own a business in business in Hawaii, and they're non-residents and they have to pay taxes here, right? Because any income that's generated here in Hawaii must be first taxed here in Hawaii. This just kind of goes to show you the size of the pension and Social Security. This is from our 2018 tax returns. About $5.7 billion of income is not taxed, right? So there's taxable returns, which they have some kind of tax liability and non-tax liability. And I would take these numbers with a grain of salt, because somebody could be taking the pension exemption and the Social Security exemption at the same time. But, you know, if I would looked at it and the amount of people who are benefiting from this provision, it's about 115,000 people, right? 115,000 people is about 1/6 of taxpayers. We have about 650,000 individual income taxpayers per year. And the estimated revenue loss from this is $382 million a year. So let's assess the individual income tax. We're going to do this for all taxes we looked at. It does provide a disincentive to work in some cases, right? Because you're not getting all the gains from your working, you're giving some to the government. Individual income tax penalizes savings in comparison to the consumption tax. Incidentally, one of the reasons that the United States is usually credited as having low levels of savings relative to Europe and things is because we have a low consumption tax relative to our individual income tax. We have higher rates. Higher rates may prompt tax avoidance. In terms of fairness, it is progressive and is one of the, it's probably the key tax that helps with progressivity and redistribution through taxes. Administrative burden is moderate compliance costs and moderate administrative cost by the government. And then in terms of stability, it is relatively stable, but much more, more volatile than GET revenue. So I'm going to go to corporate income tax unless anybody has any questions.
I do just one observation. So in European countries or other countries where they equalize things more by transfers, those transfers, of course, are paid by taxes. So are you suggesting that everybody gets taxed a lot more? Or I know that you've pointed out that they're more likely to have a value added tax or other kinds of tax structures. It doesn't come from income tax.
Yeah, right. So they generally have lower levels of income tax, but their value added tax is 20%. So you put that, that's a lot of your disposable income, right? And the European countries tend to have more universal benefits, whereas ours is income targeted benefits, right? So if you can think of that as, think about just healthcare, right? So if you're a truly low income person here, we have Medicaid. In the US or in Europe, everybody gets some kind of government paid. So people are paying more taxes. Absolutely. They're just, they don't all fall to like the higher income. The tax burden doesn't only fall in the highest income levels, right? So actually the tax burden is quite high for all individuals in Europe. And that's why the redistribution level is not as high, even though their tax rate is higher. Any other questions?
Seth, early on you had a slide that mentioned C Corps and S Corps.
Yeah.
But you didn't explain that line.
I'll probably I'm going to describe it more in the corporate income tax.
Okay, that's fine.
Unless why don't I go through this, and if I don't answer that, then we can go back to the original slide. Does that sound good to you?
Yeah, thanks.
Anything else?
I do have one question about standard deduction and exemptions, and you were talking about how they're not indexed to inflation and they're much lower than on the federal level. Are we going to have any more discussion about that? Because I seem to recall in reading through some of the previous Tax Review Commission's reports that if we did some work on those, it would reduce the tax burden on low income folks so that there would be, so that our income tax system would be more progressive.
Yeah, I wasn't going to bring up that, but if that's something that you guys want us to look into and for follow-up discussions, we can generally do that. One of the things that I like to highlight is when we look at these ways of thinking, there's two ways of lowering the burden on lower income people. You can increase the deduction, right? So if you increase the deduction, you just say, it takes longer before you get to the first dollar of taxed income. Or you could lower these rates. In both cases, they're going to affect, what you're going to have to do is you're going to have to lower these rates and increase these rates, because it's not just lower income people that are paying these rates, everybody pays these rates, right? So you really have to increase these rates if you lower those rates. And that's something that we can talk about. And you can do that either through a standard deduction or, well, standard deduction won't always do it, right? it's the exemptions that matter more. The standard deduction will force people to actually pay and file their taxes more than anything, right? Because so in the, for example, in Hawaii, a lot of people take the standard deduction at the federal level, but take the itemized deduction at the state level because our standard deduction is so low in Hawaii. So that's another thing that you can think about and we can look at.
Thank you.
Okay, so I just like to, we all kind of think of like, oh, of course, corporations should pay taxes, right? However, there's a lot of talk in the economic literature about why, right? And so you can kind of think of, this is two different tax systems. This is corporates, or what we call C Corps here in our tax line. And then there's S Corps, partnerships, and sole proprietorships, which are nominally called pass-through organizations, right? And so what happens is like, okay, you know, generally people, consumers pay whatever this company money, you know, in this case it's a corporation, this is called as revenue, and then they minus out the costs, and then they have to pay a tax on it. It's like 6.4%. There's a number of different deductions, but in Hawaii it's 6.4%, and in the United States it's now I think 20%, right? And then you have to pay a tax here. Once you distribute the profits, all the capital owners also have to pay tax on all the money that they're receiving from this corporation, right? So this would be the dividends. This would be, dividends, or it may be capital gain, something like that. But this is where it is. With pass-throughs, you pay the company money, they net out their costs, and then they distribute everything to individuals, right? So there's no tax liability here. So that's the difference. And the reason why corporations pay is there's additional incentives and advantages to being a corporation. For example, you could keep money in your corporation for years, right, without having to distribute it, which would impact the owner's tax liability. In this case, you have to pass all the money through every single year, right? So that's just a really important part, right? And so a lot of the economists almost argue that there shouldn't be a corporate income tax, right? Because everybody should just be able to pass money. These are just entities before the individuals would have to pay taxes on their rates, right? So this is, I just brought that up because it's something that like people think about a lot. And the other thing to think about is, you know, when we had this whole discussion at the national level, when you had the Tax Cut and Jobs Act, they were talking, it was mainly in the press, it was discussion of individual rates and stuff, but that was really the sideshow. The real discussion was about corporate tax rates, right? And the reason why everybody was talking about corporate tax rates is, you know, whenever you do any project, right, a company usually takes the discounted tax flow, which is like all the money lined up, and you discount it for the time value of money. And I made this really easy, but and then you have to take the taxes out of it, right? And it has to, the expected value has to clear usually some threshold that every single company has, depending on the risk adjusted and everything. But the idea with all of these tax rates is by lowering the tax rate, you're lowering the hurdle to make that investment worth it, right? So you're basically increasing the return on the investment, and ideally more investments will happen if you have a lower corporate tax rate. That's not, when you go back and look at the economic literature and people have started to evaluate this at the federal level, and they have not seen an increase in corporate taxes or corporate investments, but that's the rationale behind it. And I think it's important for everybody to understand what this debate is about, right? It's not really about, I mean, on one hand, it's like, how do you pay for the government? On the other hand, is like, does this stimulate investment, which ideally stimulates economic growth. And so lower tax, that's why, you know, in a lot of countries, they have much lower tax rates than us, nominal tax rates. Now the effective tax rate is, corporate tax rate is pretty low in the United States because we have all these deductions, but that's just something to think about. This is all economic theory, but I think it's important to know the economic theory behind this, right? Because this is where a lot of the discussion occurs. It doesn't really occur in the press, but this is really what it's about, right? Does anybody have any questions about that? Because that was a little bit more theoretical. Did I answer your question about C Corps versus S Corps, Elton?
Not really. I thought your comment earlier was related to I guess distributing monies out of the entities.
In this slide, okay, what slide are we looking at?
It was real early in your presentation. Yeah, go back.
Oh, yeah. Oh, in this case, like, so if they raised the income tax rate, these authors had found that you increase the use of C Corps and S Corps, right? So instead of paying yourself as a wage and salary person, you pay yourself as a capital owner because the tax rates are lower. So you don't want the differential between like capital gains tax and individual, like kind of wage income to be too big, or people start thinking of paying themselves through capital gains.
Yeah, but as an S corp, everything flows through, right? So you're paying tax at ordinary rates as a shareholder.
You can. My understanding with that is, I'd have to go back and look at that paper again. My understanding that is, that's true. How would you sell? You can't, like, with C Corps, you could keep the money inside of it and sell the corporation with all the money inside of it. With S Corps, you don't. I don't know how that works, to be honest with you.
Yeah, your S corp retains its character. So if you have capital gains at the S corp level, it flows through to your individual return as a capital gain. If it's ordinary income or just business income, it'll flow through to your individual return as business income subject to regular rates.
Yeah. Okay. Good thing we have a tax lawyer on the commission.
Oh, I'm not an attorney.
Yeah, I would think as tax rates go up, the strategy is to have a C Corp, not an S Corp, and retain the earnings so everything becomes a capital gains at the end of the day and not income.
Yeah.
From a rate standpoint, that's true. But I think it really depends on the type of assets you hold in the entity. Because if you have a lot of appreciable assets, you probably want to be S Corp and just pay tax once on the gain. Because in a C Corp scenario, you're paying tax twice, one at the corporate level and again at the shareholder level. That's one of the basic differences between a flow-through entity and a C Corp. But from a rate standpoint, Murray, you're correct.
Okay. In terms of why is corporate income right? It's really small. It usually is about 1.5% of all total collections. Of the 44 states that collect corporate income tax, we rank the lowest in per capita corporate income tax collections. Our corporate income tax does fall in the center, in the middle of everything. It's between, you know, ours is 6.4, and that's between the 3 and the 12% in different countries. We don't have about half of our, if I'll have to look at the, now I'm operating from memory, but there's less C Corps than there are S Corp. There's more S Corps and partnerships, and about of the taxable income, they're about 50-50 between C Corps and S Corps and pass-through entities here in Hawaii. So we definitely have more pass-through entities than we do have C Corps here. And then we kind of this funny thing that, like, I don't know why we have it, but if it's less than $100,000, you have different tax rates, lower tax rates. That makes more sense for individual income tax because there's an individual ability to pay. But corporations don't have an ability to pay, right? Presumably all of they're making a profit, and everything they made a profit on, they can pay equally. So that doesn't quite as make much sense from economic perspective. And also our capital gains rate is lower than the income rate. Just something to think about, and it's always debated, is, you know, the corporate income tax, who bears a burden for that? It's usually a mix of workers, consumers, and owners of capital. How that's all distributed is very much debated. It's thought now, yeah, it's very much debated, so I don't want to get into that. And this was just kind of a talk. I talked about this issue of ability to pay, which really doesn't apply to corporations. And that's it. So thank you very much. And tell me your questions. Anything else?
Thank you, Seth. That was a lot to take in.
Fire hose approach to tax education.
Yes.
And again, I can go over this a number of times. The idea of these presentations is to give you a background and start to get you guys thinking about tax policy, how it operates in Hawaii, different considerations to take into account.
Seth, as we move forward and try to figure out what some of our better options are, I have found the report that the 2017 Tax Review Commission had from PFM was the company. Yep. The one that it's a voluminous report that discusses the tax system in its entirety. And I think I have learned a lot from that, and I think that we could all learn from that. And I was wondering if for our benefit, since we may not be able to bring in any consultants, whether staff would be able to review that and identify areas where we need to bring it up to date, changes that have been made in the significant parts of the tax code since that was done in 2017.
Yeah, I can take a look at that and see if it needs to be updated at all. My first response is nothing's really changed. Like tax rates have gone a little higher, but like nothing's really changed in the last 4 or 5 years. But we can take a look at that and see if you have any other questions.
Thank you.
Mm-hmm.
Anything else from any members? Recommendations for the next meeting? Seth, do you have ideas about what we need to cover in the next presentation of our tax system?
The next one I talk about TAT and I talk about property taxes, how that works here in Hawaii. That's the next one I was planning on. However, I deferred to the wisdom of the commission. We serve at your pleasure. So whatever you guys need.
Thank you. I think one of the things that I recall reading in several of the past commission reports, and also something that the legislature is going to be looking at this year, relates to GE tax exemptions and tax credits. And I know that you did talk about that a little bit in our presentation on GET, but I wonder whether maybe there are some additional things that we could learn from that.
Yeah, I would. So my suggestion would be the first thing, let me show you what's online from the tax department. We have all of the tax GE exemptions online. Here, let me share screen. You can see my screen right now.
Yes.
So if you go to data dashboards here, and you go down to GET exemptions, this shows you all of the major exemptions by year. So like you can pick different years. We only have 2 years available, but you can look at that. What other, as opposed to just the amount, what other things are you interested in?
Well, I don't know whether you actually have anything to offer here, but I know that there has been discussion about what does the state get in return for offering these tax benefits.
Yeah.
Sorry,
So go ahead.
There's a legislative audit. Legislative auditor was charged with reviewing tax exemptions, a set of tax exemptions every couple years, I think. There's a 16 or 17, 18 review of certain tax exemptions that came out in June of 2020. So that covers, it basically assesses that question. Some of the answers are inconclusive though. So it reviews the effect of the tax exemptions, GT exemptions.
Yeah, and in that case, in last year, they looked at the airline services related to airlines and the subcontractor deduction.
The movie credit, yeah. Yeah, I mean, you look at these, this is definitely a list of apples and oranges because some of these are clearly public policy decisions by not taxing certain things you want to encourage, like affordable housing or drug sales. You know, you're looking at basic necessities and or things that you want to encourage as a public policy decision from the legislature, whereas other things are an efficiency and fairness issue, like subcontract deductions. It's kind of double taxation if you hit the same activity twice. So it's really a bunch of apples and oranges here. These exemptions are here for very different reasons, in my opinion, I should say.
That's right, right. And what you really see is the most expensive deductions are they're either, you know, we don't really tax out of state sales, right? You don't usually tax exports, but they're in foreign trade zones. So if you take those out, they're like nonprofit, which is a policy decision, drugs, policy decision, subcontractor deduction, like you were saying. However, even with this, it's not like this isn't money, this is amount exempted, right? So this doesn't even represent lost revenue. You can, I think we have the GET expenditures. This is the expenditure amounts, right? And so you can click here. And you can see, oh yeah, the expenditure amounts are right here. And it's nonprofits, right? And so those are the hospitals. And you can go down the place from there and look at really what's driving things. And then there's like smaller amounts down here.
Sorry, which did you say was expenditure exemption? Which is the better measure of lost revenues? These things.
Expenditure amount.
Expenditure.
Exemption amount is like the amount that they claim, but because not everything is, you know, when we look at the expenditure type, you apply different rates to it. So for the nonprofits, these are usually final sales, so they would be exempt at the 4% rate. But like if you look at the subcontractor deduction, this would be at the 0.5% rate, right? Because it's an input to the final sale. That's our assumption. You can argue with whether that's correct or not, but
the deduction, just to be clear, and I think we all know this, but just to make sure that this nonprofit organizations is the potential revenue lost, although it is a policy decision because we're not taxing
yes,
nonprofit organizations. This is not to be confused with deductions that you get for contributing to a nonprofit organization.
correct.
So you said the expenditure amount is the amount of taxes that the state forgoes. Is that right?
Yes, that's the estimated amount of taxes that forgoes.
Okay.
We may always make the thing that these are kind of generalized reports. And then if once the legislature makes a specific proposal, then we go back and really look at each one of these. So it doesn't represent an official revenue estimate, but they're good like ideas about how much the state would save if they got rid of these exemptions.
And the exemption amount is what?
That's the amount of like economic activity that they say we don't have to pay taxes on.
Oh, I
So
see.
for example, nonprofit, this is 239 million is 4% of 5.9 billion.
Thank you.
And then if you guys do have questions about, you know, we have one for tax credits. So you can like play with these things too. If you're looking at really what are the major tax credits claimed, and you see that they're, you know, the two top ones are the renewable energy tax credit and the motion picture tax credit.
Sorry, what year is this?
This is probably all of them. This would be 2008.
That still seems high. I thought I just read the other day that the RETITC, the renewable energy income tax credit, was only like 40 or 50 million just a couple of years ago. So the 70 seems high.
It's been around, it's between 70 and 80 for the last couple of years.
Okay.
And then for the motion picture tax credit, there's a limit of $50 million. So this will go down a little bit going forward.
Is that just a cap, an overall cap?
Yep.
So I'll throw one thing out, Seth, and I obviously am just one person on the commission, not speaking for the group, but one thing that I mean, I also want to hear the presentation that you would normally do for the next meeting. So I'm not saying anything different than that. But one thing that I've been very curious about ever since you brought it up, and after reading the past 2 Tax Review Commission reports, and also added to my curiosity was only piqued when you mentioned that the exemption of pension and Social Security, or defined benefit and Social Security retirement amounts, is basically $382 million in lost revenue. Understanding that several of the past tax review commissions have brought up that same point, because it seems to be a major inequity to have 2 low-income retirees, both with the same income, one whose income is the sum of Social Security, let's say, and a pension, and the other whose income is from 401k. That 2 retirees making the same exact amount of money, one gets taxed and the other doesn't. I mean, that's just stunning to me in terms of inequity, and if I understand that correctly. And it sounds like that inequity is not only an inequity, but potentially costing the state $382 million. Now, I understand that nobody likes to tax grandma and grandpa who are retirees on pensions and Social Security. We are taxing them if they're getting the 401k. We're not taxing them if they're getting a pension, which again seems like a huge inequity. Now, the only way that you can partially counter all the calls the legislature will get if we were to recommend such a course of action is the other thing that frequently gets recommended by past tax review commissions, which is to increase the personal exemption, the standard deduction to federal levels, basically update them for inflation, which several past TRCs have pointed out. And so I guess I find myself curious what the net would be. So if we tomorrow, just for argument's sake, if we tomorrow were to update the personal exemption, the standard deduction to federal levels, or to 2019, whatever federal levels, so bring them up for inflation, and then maybe even index them for inflation going forward, that's going to reduce people's taxable income on the lower end of the bracket, like immediately. And how would that net out against this pension and Social Security issue in terms of what grandma or grandpa actually end up paying for taxes? How do those two net? That's what I'm curious about, because having exemptions and deductions that I think you said they date back to the 80s or 70s or 80s or something like that. It's just ridiculous on its face, and yet they don't want to increase those because they're worried about lost taxes. But there's this 382 million that's sitting there from this inequity between defined benefit and defined contribution. So it's things like that that seem to be wrong, seem to be just flat out wrong on their face, or out of date, whatever you want to call it, that I'm curious how they net out if you did both those things at the same time. That's just my personal curiosity. Again, I don't speak for everybody, but that's the type of thing I'd love to see modeled, if that's possible.
We could certainly model that, and we welcome that. I would just request that the council comes together, decides on the different scenarios, on what they would like us to do and explore, and then we can come up with that for sure.
Yeah, definitely just saying that as a single person's idea.
Yep.
So, sorry, one of the I guess tasks or missions of the commission is to assess the adequacy of the tax system, right? So one of the things in reading the last 3 tax commission reports that I am not sure of what the answer is, and this might be a very easy answer, is like what is the size of the post-retirement medical and pension deficit that we currently face? Because I've read things between 14 and 26 billion dollars. So I think the focus of the current budget session is on the current $1.4 billion shortfall for the next 4 years. But I mean, I think the issues that we've been having for the last decade are still here, and we pushed the can down the road with not funding those things. So I'd like to get an idea of what the target is. I mean, what the big hole is that we have in this pension and post-retirement number, which I really can't. I mean, the $14 billion number is the most common number I've seen. So is that something that's readily available? Because I think we need to address that in any kind of report that we have.
Yeah, we can get information for you. I mean, as you guys all know, those assumptions, they're all relying on a number of different assumptions, right? You're like, the amount of, well, the amount of money you put in is really easy. The rate of return that you get, the length, and since we're talking about 20 or 30 years, 1% is a couple $2 billion of whole, right? And then there's 2 issues here. One is the ERS, and then the other one is the which is the pension system, and they have a better idea of the liabilities that they're going to entail. And then the bigger one is the medical payments for retirees, which is harder, and it's more of a pay-as-you-go system, and has an even bigger hole. And we can either bring in somebody to brief you guys. Probably the best thing would be to bring people in to brief you guys on that, and look at those issues.
Thank you.
Thank you. Any other?
The other thing, when we talk about adequacy, I would like to give you a presentation on growth, because everybody, what I find is people are always trying, and the ledge is this because they have to balance a budget, right? At least on paper. But really, the difference between a pension crisis and no pension crisis in Hawaii is the difference between 2% revenue growth and 5% revenue growth annualized, right? And so the best thing you can ever do for adequacy is ensure that Hawaii's economy grows better, right? Because that will increase more tax revenue. It'll allow people to make investments in the pensions. It will be able to pay teachers. You do a number of different things, right? But this whole idea of just, we have to plug all these budget holes and we use little fixes doesn't really capture the enormity of the stakes. Because a couple $2 billion, honestly, over the course of 20 years is not a big deal as long as you're growing. If you adopt a no growth mindset and you adopt a bunch of policies that make it much harder for businesses to grow and the economy to grow, then adequacy becomes a much bigger problem, right? And I always try to like really emphasize that fact that, you know, it's much better to have a bunch of policies that allow for economic growth, because that creates way more tax revenue than actually even raising rates in some cases.
So I guess on another point, from the headlines, is the unemployment tax situation within our scope too, or is that something we need to talk about?
Past commissions have not taken it up. Again, you did not, you, the commission, did not receive as much direction as other past commissions. So you are at the, you have the privilege of coming up with your own, or you're privileged and cursed to come up with your own little direction on what you guys want to do.
Okay, no, I just didn't know what our
Yeah.
scope was exactly.
Definitely a big problem. My sense is that they're going to have to make some sort of action this year before our report even comes out. So super
It
big
could be a
issue.
long-term problem too, frankly. Yeah.
Seth, is there anybody that you know of available, I guess somebody from the Department of Labor who would talk about that, or is that under the purview of Department of Taxation?
No, that's Department of Labor. So if you guys wanted to talk about that, we could bring somebody in. I would decide, my recommendation is to decide, you know, my recommendation so far is I'm giving these presentations, kind of getting the juices flowing, and then you guys pick what you want to focus on, right? Because past commissions have had difficulty when they just grasp at every single interesting tax issue that they want to, and they tend to flail about and not be as focused, and then they all rush at the very end. My recommendation to you is, you know, in the next 2 or 3 months, you guys really sit down and decide what you're going to study and what questions you want to answer, right?
Seth, is next month the last of your formal presentations that you've prepared?
Yeah, again, I have next one is TAT and property. I have the ability to give another one on kind of growth and who pays Hawaii's taxes. So looking at like the distribution of taxation as the system as a whole, right? So generally when you don't look at, you know, if you looked at just a GET, you would have different implications than if you looked at the whole tax system, which offers tax credits to offset the GET. Those are kind of like the ideas. But again, I'm serving at the pleasure of you guys.
So it sounds like one more for sure, with the possibility of a second one.
Yeah.
Because I would think that we would want, once the formal presentations are done, whether it's next time or thereafter, I guess, Beth, I'm assuming we want to get our heads together pretty quickly and figure out what we want to focus on.
Yeah, I really do think, as Seth recommended, that we pretty quickly narrow our focus on a few areas that really seem productive, and start exploring them in greater detail and modeling some of the changes that we might want to see. And I also just want to note that we should keep our eye on the future and not our immediate crises, because by the time we produce anything, it would be too late. So I think the question about economic growth, about population change, about the aging population, all of those things, and about the EUTF and ERS contributions, all of those things need to be taken into consideration. But our interest will be a longer term future, and I hope that we'll be able to narrow the focus to just a few of the things that we want to explore.
Yeah, I mean, frankly, from my point of view, I mean, the last 3 commissions over the last 10 years, they've said a lot, and you know, I think it serves us as being efficient that we relook at some of the topics that they covered and update them. But I don't know if there's that much new ground to cover. I mean, they've said a lot and it's been very impactful. but maybe it's just, focusing on a couple of things from the past 3 reports that haven't got any traction. And in this particular case, we need to bring that back up and just update it. I mean, that
Yeah.
would be my point of view.
Yeah, I share a similar view that given that we have less time, as I pointed out, and really no money for a consultant, I think there's been, from what I read, just the same kind of advice that there's good information out there. There's good stuff that is in the past tax review commissions. I think it's probably more about reframing it and maybe trying to net some of these things out and showing the total combined financial impact of these things than trying to come up with something completely new and unthought of.
Yep.
Okay, well, if there is no other comment, then let's talk about our next meeting. I believe that would be on February 17th from noon to 2. And have we already decided that we are going to set aside the third Wednesday from noon to 2 for the rest of the year? If not, I think that that would be good because I know how busy everybody's schedule gets.
Beth, I'm not able to make the 17th from noon to 2. I have board meetings at the same time. So it doesn't mean you need to reschedule it, but that's just a non-movable meeting for me.
Is that going to come up again in the future?
Let me see. Not necessarily. No, if it's the third Wednesday, not always. But sporadically.
Beth, I have a conflict on the 17th as well. And the rest of the year, I'm okay. It just happens that I have something else on my calendar. So if we can move that date, I would appreciate it. But if we can't, then that's fine.
Okay, I know that it can be difficult to get everybody together on the same date. Seth, if you and staff could see if we could find another date for February, and then let's try to set our meeting schedule for the rest of the year to the extent that we can.
Can we do it now? Just with the sunshine law, it's a lot easier for us to all talk about a date collectively than, because last time I tried to do it, I sent out an email to everybody individually. 5 people say yes, the 6th person says no, and then I have to send it out. So I would encourage you guys to find the date now versus asking us to try to figure it out.
Okay, that's fine. Are there other days that week from noon to 2? Say, could we do it on Thursday, the 18th?
Yeah.
Just a comment, is there any way to maybe move it up quicker for this next, so it gives us more time? I'd rather cut down the time on our next meeting. Just my comment.
Okay,
Like,
are
maybe the
you
Wednesday
interested
before,
in
maybe the Wednesday before the 10th?
the 10th?
That works.
10th wouldn't work for me, I'm afraid. I'm sorry. The 17th would, but ironically, the 10th won't.
Okay.
I mean, Friday the 12th I could do. Friday the 19th. I guess we already said no to Wednesday the 17th, but that's open for me as well.
How about Friday the 12th? Can everybody do that?
I can make it happen if we need to.
Yeah.
Yeah. Yes.
Yep.
Okay, why don't we plan on the 12th from noon to 2?
Okay.
And are we going to send out a string of dates for the rest of the year, or how do you want to do that? Because the farther out we schedule, the more likely I think probably all of us are to not have conflicts.
Right. So, Kate, why don't you let us know, or if any of you have dates in the future on the third Wednesday from noon to 2, alert us and we can try to schedule around that.
Okay.
Okay.
That would just be responding to the group email from setting up this meeting or something.
Yeah, you can let us know, and then myself or Rick will take all that into account. We can send all that information out.
So Friday the 12th, noon to 2, and then check the third Wednesday for every month thereafter, 12 to 2.
Right.
Yeah, we'll send out an email to try to get the third Wednesday of every month thereafter and see if there's any conflicts.
Okay.
Okay.
Okay, if there is no other business, then let us adjourn. It is 1:35.
Okay.
Thank you very much.
Thank you,
Great,
everybody.
thank you
Thank
very
you.
much.
Thank you all.
Come on.
Bye.
Okay, bye.
Bye.